G'day guys, Mitch here from Finance Fitness Coaching. Today I want to talk about return on investment, cash on cash return, some of these numbers and formulas that we use as investors, entrepreneurs, multiple property owners, that sort of stuff. It's really important to know these numbers, and you need to be able to work them out very quickly and very efficiently without having to waste too much time. Because you've got to look at hundreds and hundreds of investments, hundreds and hundreds of deals, being able to quickly analyse them and then say, right, this one needs further investigation, or just put that one away, it's not even going to bother paying for itself. So the number one thing that we start with when we're working in calculations, let's say for example on a rental property, is the ROI, or the return on investment. Some people, I would call this a gross return on investment, because the net return on investment is also another figure later on. But the ROI, so let's say we find a property that rents for $500 per week, we then annualise that figure at 52 weeks for the year. Now that's assuming there's a no vacancy rate in this property. So obviously if there's a vacancy rate you need to have a look at that. But we're going to assume that the rent is then annualised. So that gives us a $26,000 return. Now remember, I'm talking just gross numbers here. So then we're going to say, right, well the property is worth $440,000 to buy, or is listed for $440,000. So we take our annual rent and then divide that by $440,000. So $26,000 divided by 440, and then we multiply by 100%. So divided by 440, then multiplied by 100, gives us a gross return on investment, or ROI, of 5.91%. Okay? So you would look at this property and go, okay, well that bears interest. If I was to pay the full purchase price, which you never will, then I still get my $500 a week, and if I was to rent it every week of the year, my gross return on investment is 5.91%. And I go, okay, well let's look further into that, because the cost of my money, let's say for instance it was investment, the cost of my money is around 4.6% for my home loan at the moment, okay? So as an investor I might be 4.6%. So I would see that there's a little bit of fat in there of around 1.31% is around about the net numbers associated with this property. Now if I buy well, if I don't use, if I can improve the rent somehow, or if I can drop the purchase price somehow, you know, I'm factoring in that we're borrowing the whole 440. Now obviously when we do our net return on investment figures, we would obviously look at, you know, where's the skin, where's the creativity in this deal? Can I improve the rent? Can I drop the price? Where's this 440 coming from? How much of that 440 is my deposit? How much of it is borrowed? Is it all borrowed? Is the stamp duty, what's the stamp duty payable on that? Because you know, as it is, when you buy a property for 440 grand or 500 grand or whatever it is, you don't just pay 500,000, you've got to pay stamp duty and buying costs as well. So basically, we do our property search and our suburb search and our number search based on this number first, which is called our return on investment, or gross return on investment.